There is a quiet, persistent anxiety that settles in once you cross the threshold of 50. It is not the loud, frantic panic of youth, but rather a calculated, heavy realization that the runway is getting shorter. For decades, you followed the script, you worked the hours, paid the mortgage, and contributed to the funds that were supposed to guarantee a graceful exit from the workforce. Yet, as you look at the balance sheets today, something feels fundamentally broken. The numbers are higher than they were 20 years ago, but their power has diminished. You are witnessing the silent erosion of the American middle-class dream, where the goalposts for a secure retirement are being moved further away just as you are preparing to cross the finish line. We are living through a period of profound economic restructuring, and if you are over 50, you are standing at the epicenter of this shift. The strategies that worked for your parents, and even the strategies that worked for you a decade ago, are now becoming liabilities. There are specific structural forces at play that are draining your net worth every single month, often without you even noticing. If you value this kind of deep dive into the mechanics of our economy and want to protect your financial future, please consider subscribing to the channel. It helps us continue providing this level of analysis for those who refuse to let their hard-earned savings be dismantled by circumstance. The first and perhaps most insidious mistake is the misunderstanding of real-world inflation versus the figures presented in headlines. For a person over 50, the Consumer Price Index is a deceptive metric. Your personal rate of inflation is likely much higher because your spending is concentrated in the sectors that are inflating the fastest: healthcare, property taxes, and specialized services. While technology or apparel might fluctuate, the core costs of maintaining a dignified life in your 50s and 60s are on a relentless upward trajectory. By relying on general inflation data to plan your withdrawals or savings goals, you are essentially planning for a world that no longer exists. This creates a standard of living gap that compounds over time. When you underestimate the cost of your future life, you inadvertently overspend in the present, creating a deficit that becomes impossible to close once you transition to a fixed income. This is not just about rising prices. It is about the loss of purchasing power in the very years you need it most. Compounding this is the trap of lifestyle maintenance in an era of shrinking margins. Many Americans in their 50s are still supporting adult children or aging parents, the so-called sandwich generation. While the emotional impulse to provide is noble, the financial math is often devastating. We see a recurring pattern where those in their prime earning years sacrifice their own liquidity to bridge the gap for others. In a stable economy, this might be manageable. In an economy defined by volatility and high interest rates, this is a form of financial self-sabotage. Every dollar diverted from your debt reduction or your principal investment today is worth 5 times that amount in lost security a decade from now. This is a hard truth to swallow, but the reality is that your retirement cannot be financed with a loan, while a child's education or a first home often can. Failing to prioritize your own oxygen mask first is a mistake that is making millions of Americans poorer every month as they trade their long-term stability for short-term family subsidies. A deeper structural issue lies in the traditional 60/40ths portfolio, which many have been told is the safe harbor. In the current macroeconomic environment, this classic allocation is facing a crisis of identity. With the correlation between stocks and bond shifting and the specter of debt-driven market volatility, the set-it-and-forget-it mentality is now a high-risk strategy. Many over 50 are sitting on legacy investments that are poorly positioned for a high cost of living future. They are paying hidden fees to advisors who are using outdated models, or they are holding onto assets that are no longer productive in a post-globalization economy. If you find this analysis of the structural flaws in our current financial system helpful, subscribing is the best way to stay informed. As these trends evolve, we aim to provide the clarity needed to navigate these complexities with confidence, rather than fear. We must also address the home equity illusion. For many, the house is the largest asset on the balance sheet, but a house is only an asset if it generates cash or reduces expenses. For the American over 50, a large aging family home is often a liability disguised as a windfall. Between rising insurance premiums, which are skyrocketing across the country, and the increasing cost of maintenance and property taxes, the family home is frequently a dry rot in the retirement plan. Many wait too long to downsize, holding on to square footage they don't use while their liquid cash is drained by the friction of home ownership. This emotional attachment to real estate prevents the transition to a more agile, liquid financial life. By the time many realize the home is consuming their monthly cash flow, they are forced to sell in a panic or a down market, rather than as part of a strategic exit. Furthermore, there is the mistake of tax blindness. Most people focus on what they earn, but for those approaching retirement, the only number that matters is what you keep after the government takes its share. We are staring down a future of massive federal deficits, which historically leads to higher tax environments. If the majority of your wealth is locked in tax-deferred accounts like traditional IRAs or 401ks, you have a silent partner in your retirement who may decide to change the split at any time. Failing to diversify the tax treatment of your assets, not just the assets themselves, is a massive oversight. You are effectively gambling that tax rates will be lower in the future, a bet that seems increasingly risky given the current fiscal trajectory of the nation. The final and perhaps most psychological mistake is the retirement date fixation. We have been conditioned to believe that 65 is a magic number. This arbitrary date often leads people to make drastic shifts in their investment profile or to stop working entirely before they have reached a true point of sustainability. In the modern economy, retirement should be viewed as a series of transitions rather than a binary switch. Stopping work completely in an inflationary environment is one of the most dangerous moves a person can make, as it removes the only hedge you have against rising costs, your own earning power. Those who are thriving are not retiring. They are pivoting to lower stress, high-value work that keeps them engaged and their capital untouched for longer. As we look at the landscape of 2026 and beyond, it is clear that the path to stability is no longer a straight line. It is a narrow bridge that requires constant adjustment and a willingness to see the world as it is, not as we wish it to be. The pressure on the middle class is real, and the margin for error has never been thinner. But knowledge is a form of capital in itself. By identifying these leaks in your financial bucket, you can begin to plug them. If you have found value in this perspective, I invite you to subscribe and join our community. We are committed to digging beneath the surface of the news to find the truths that actually impact your life. The future does not have to be an era of scarcity, but it will certainly be an era of discipline. Take a moment tonight to look past the balance sheet and see the trajectory. The most important investment you can make right now isn't in a ticker symbol. It's in your own clarity of vision.